All right, good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to 5 steps to avoid the biggest mistakes investors make and clear the way for confident investing. Our presenter today is Sandy Chaikin, co-founder of Chaikin Analytics. Now, Chaikin Analytics is not registered as a broker-dealer or investment advisor, either with the U.S. Securities and Exchange Commission or with any state securities regulatory authority. Chaikin Analytics is for educational purposes only and is not a trade advisory service. Past results of any trading system or methodology do not guarantee future results. Users bear sole responsibility for their own investment research and decisions. Throughout our presentation, if you have any questions, please submit those questions using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. I'll be available throughout the presentation to respond to any kind of questions that you may have. As a reminder, this webinar is being recorded and a copy will be sent to everyone who has registered. Now, a bit about Sandy Chaikin. With no prior experience, Sandy started investing in 2012 with Chaikin Analytics and built a killer portfolio that outperforms the S&P 500 and most money managers. Sandy is living proof that you do not have to be a financial expert to pick winning stocks. She presents webinars and speaks at industry events on fearless investing by following the Chaikin 5-step method. Sandy is also presented at NASDAQ and industry conferences on fearless investing. Prior to co-founding Chaikin Analytics, Sandy started her own marketing and communications firm in a career that spanned over 30 years. She's held senior management roles for Elizabeth Arden, L'Oreal, and the Franklin Mint. She's also a member of Elevate, a global professional women's network, and Women in Investing Network of Philadelphia. So now, to get us started, here's Sandy Chaikin.
Attending today's presentation. As Joe said, we're going to go over 5 steps for how you can avoid making the biggest mistakes that most investors make. So I always like to frame the conversation with kind of a universal problem, which is that the S&P has grown an average of 10% over the past 20 years, which is a pretty healthy gain. It's the S&P is up 12% so far this year. Yet individual investors have only averaged 2.5%, which is pretty meager compared to the 10% average. And why is that? Well, primarily because people buy on emotion, not fact. And that's really what today's webinar is all about, is how to get the emotion out of your decision making and have you rely on facts and not your own emotions when you're making these types of investment decisions. So what is the secret to building a killer portfolio and becoming a more successful, confident investor? Because I'm a firm believer that you can't be a successful investor unless you're a confident investor. So you've got to have the right tools and backbone behind you to feel confident and make great decisions. So that's my promise to you, that you're going to discover how to take control of your financial future by avoiding these key mistakes. And that's, of course, so that we can make more money in the stock market. I grew up where it was kind of verboten to talk about money, but that is what it's all about. So we're all in this game so that we can generate more revenue for however we want to spend it, putting away for retirement, celebrating, as Mark and I do here on vacations that we take with my profits, paying for children's college or school tuitions, whatever it is, that you want in your life. It's all attainable if you have the right system to get you there. And that's what today is all about. So why should you listen to me? Well, as Joe said, I've been investing since 2012 when I started as a novice. And since I started investing 5 years ago, I've beaten the S&P 500 and 4 out of 5 pros. So when I started investing, I went into stocks that were kind of the bigger names that I knew of: Yahoo, Southwest Air, for instance, Skyworks, which is a chip supplier to Apple phones. And those did well for a while, but then I got into the smaller cap stocks in 2016 and realized some huge winners in stocks like Centa, Quad Graphics, and NACO, all of which are up over 100%. And I think the market up at that time was up about 9 or 10% for the year. So these were big wins. And I only invest in 8 or 10 stocks at any given time. That's typically the size of my portfolio. So you have these kind of big outsized winners in there. It can really make a big difference. Now this year, I've kind of done a mix of small cap and mid and large cap. Cigna, for instance, is in my portfolio. Lam Research up 70%, and Carlyle Group, an investment banker, up 54%. And those are 3 out of the 8 or 10 stocks that I currently hold. And I do this on 10 to 15 minutes a day. And that's the process I'm going to share with you today, so that you're not overwhelmed with going to multiple different platforms and researching all sorts of stuff and facts and trying to put them all together. It's all here on one chart. And I'm going to show you how I manage this in 15 minutes a day. So before we get started, if you could just share with me, and Joe will put up a poll question, some of the challenges that you're faced with, and you can check off however many that apply to you. And these typically are the challenges that hold people back. You know, what is it that gives you pause when you're about to buy or sell a stock? You know, what goes through your mind that enables you to complete that action? And if you could just jot your answers in here, we'll tally them up in a minute. And that way I will get a better sense of where you all are coming from.
And just to chime in here, it looks like we've got a good number of results coming through already.
Okay.
Give it about probably 10 more seconds, and then we'll show the results.
Okay, great.
Looks
great,
like there's
Joe.
already one result out in front among the rest.
We have a clear winner here.
Yeah, let's see. Let's still more coming in.
Okay.
And that's good. The number keeps going up and up. All right, let's take a look. Bear with me for a second. And it looks like timing. 78% of the people who responded said timing is one of the challenges.
That's always a biggie, isn't it? Looks like fear is 2. What do we have now? 3 is emotions.
Mm-hmm.
Uncertainty is 4. Is there anything underneath that, Joe? Underneath uncertainty?
Information over nothing below uncertainty in the market. No.
Okay. Okay. Well, wow, timing. That's the big winner, isn't it? All right, thank you for completing that. That's helpful. But I have anticipated that, because every time I ask this question, I tend to get similar results. And that's what is baked into my presentation today, is to address those major challenges that you're facing so that you can overcome them and invest with confidence. So here are the 5 that we're going to be addressing today, and you'll see timing there is the last one, your number 1 concern. So we need to make sure we allow time for that. Don't have the right tools, pick poor stocks. You know, that's worded in a number of different ways. Lacking confidence, trading on emotion. I know that was a big one. I think that was number 3, trading on emotion. How do you know what's hype and what's real? You know, fear of loss. That was, I think, your number 2. Concern, and that gets into holding a stock too long. And then, of course, timing is your biggest challenge, when to get in and out of a stock. So we'll be going over each of these, and they do overlap one another as well. So by the end, I think you'll have a very good picture of a plan to follow. And that's what it's all about, is having an objective plan and tools you can trust. So this is just a sample of the type of stock that we're going to be talking about today, as the type of stock that you obviously want to invest in. So this is the pattern you want to look for. This is what we call a classic bull. You'll see on the slide everything is green, and I will get into explaining what all this means. But just if you can take a glance at it now, I think you can pretty easily tell this is a winning stock. I mean, look at that price trend going up. The yellow arrow over by December is when I bought this stock. This stock is now up 41%. So I'm going to show you how to find stocks like these and know when to get in and know when to get out. All right, so the first challenge we're going to talk about is not having the right tools. And that equates to picking poor stocks. If you don't have the right tools, it's pretty hard to pinpoint what you should buy and what you should avoid. It also gets into information overload. There are so many, I guess you could call them tools, news services, internet, emails, financial news cycles out there, all kind of bombarding you with information. It's hard to know what's right and what's going to guide you and what's not going to guide you. But this is all boils down to the fact that individual investors on average only increase by 2.5% a year, whereas the S&P is up 10%. And we all basically measure ourselves against the S&P 500. That's a pretty standard barometer of like a benchmark. And 10% a year is not bad. It's up 12% this year. That's not bad. But if you want to make those outsized returns, like on Cigna, 41% this year, you're going to have to do something a little differently than putting it into an S&P 500 index fund. So here's a little more kind of fact that'll give you some consolation as to why we're also inundated with information. Is that in the organized book that I had access to, he says that in the past 10 years, more information has been created by humans than in all of human history. I mean, think of it. In the past 10 years, that's not a lot of time, and no wonder we're bombarded and feeling information overload. But our human minds haven't changed. I mean, we can only pay attention to 3 or 4 things at a time. So think about all you multitaskers out there. You're looking at your stocks. You might be typing an email or reading an email from somebody. You might be glancing at CNBC on the TV. It's very distracting to try to do all these things and really focus on what you need to focus on at a given time. And many of the facts and stories and recommendations that you'll get on the financial news networks, for instance, are not always right. So according to tip ranks, 86% of analyst recommendations have buy ratings, which are wrong 50% of the time. So you could be 50% right, or you could be 50% wrong. But bottom line is you don't want to depend on an analyst or anyone else to give you a recommendation for a stock buy or sell. You want to be able to trust proven tools. And for us, that's the Chaikin Power Gauge rating. This is a very simple rating, as you can see here, going from very bearish to very bullish, that looks at a stock's potential to out or underperform the market over the next 3 to 6 months. So think of this as a GPS for stocks. It tells you where that stock is headed. And there's a lot more going on underneath that simple gauge that meets the eye, but it does cut through all of the clutter by its simplicity. It solves the information overload problem. And it gives you a simple but not simplistic answer about a stock. So as you can see here on AMAT, this has been a very strong stock all year. It's giving you a very bullish rating on this. And you can see underneath that overall rating that there are 4 basic components: financials, earnings, technicals, and experts. That are 4 components that underneath each one of them house 5 factors. So this model is made up of 20 factors. And how did this come to be? Well, my husband, Mark Chaikin, created tools for institutional investors for over 40 years on Wall Street. And he retired. And then after the 2008-09 financial meltdown, he could see that there were many individuals like myself out there who were discouraged with Wall Street, had taken our money out of traditional brokerage firms, put them in self-managed accounts like I did. I opened an account at Vanguard. Yet we didn't have the tools, the education, or the know-how to be able to manage our own investments. but we knew we didn't want to go back to Wall Street and depend on somebody else. So Mark said, well, I'm going to wrap up all this knowledge that I learned and wrap it into a model and a system that is simple enough for an individual to understand, yet complex enough to give you the same professional information once available only to the Wall Street pros. And that's exactly what he did with his power gauge rating. So John Carter, who is a partner of ours and a well-respected name in the financial service area, calls this an objective awesome meter for stocks. He says there's a lot of hyped up tools out there, but a single tool that combines 20 fundamental and technical factors to anticipate a stock's profit potential got my attention. It's the power gauge rating. At first glance, I thought this looked like an objective awesome meter for stocks. And he likes it includes fundamental and technical analysis for stock selection and timing. Most systems either include, or models, I should say, are either fundamental or technical. This is a blend. It's actually 85% fundamental, 15% technical for those of you who want to know. So what are those 20 factors? Well, Mark started with 200 factors, and over the course of a year testing them, he whittled it down to 20. And these are the 20 factors that tested highest in terms of predicting the stock's profit potential. And these are also the 20 factors that an institutional investor will look at every day when they're evaluating a stock. Now, I highlight 3 of those 20 in red because you can drill down on any of these 4 components to get a rating, a power gauge rating on any of those 5 subsequent factors for 20 factors. But really, if you go through each one by one, I think that's information overload. So what I do is look at the overall rating. If I'm going to buy a stock, it's got to be at least bullish, preferably very bullish, but at least bullish. If it's not, pass. If it has a neutral rating, skip. Certainly if it has a bearish rating, avoid at all costs. Other than that, that's how I use, other than looking at these 3 red ones, that's how I use the power gauge. I will drill down on price to sales, which is an important indicator of the value placed on a stock. I do look at short interest. The short sellers are considered the smartest guys on Wall Street. I don't want them shorting the stock or, in essence, betting that my stock's going to go down. If I'm going into this on a swing trade, I'm expecting that stock to go up. So I want them to be bullish, which means they're not shorting it. I want the insiders to be buying it, which would also give it a bullish rating. Insiders know more than you or I do about any given company because they're typically they're insiders. They work there. They're in management. They know what's going on in a company. So they're in a prime position to evaluate whether they want to buy that stock or not. They may sell it for numerous reasons because they need to raise cash. They're only going to buy it, and that's what this factor represents. They're only going to buy it because they think that stock's going to go up. So I want them buying a stock that I'm looking in. And other than those 3 factors, as I say, I look at the overall rating and expect it to be at least bullish, ideally very bullish, before I consider buying a stock. Likewise, when a stock that I have has a rating that turns to neutral, then I start looking at it. I'll drill down. I'll look at these 3. What's happened here? Why is this stock going to neutral? And that's usually the first alert, that something's going wrong with this stock. Excuse me, and alerts me to take a closer look. Okay, so why should you depend on a model? Well, a very successful investor and analyst says models beat humans because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by emotions and opinions. And there's that emotion coming in there again. So the best way to get the emotion out of this is to depend on a model. Obviously, you want the model to work. Power gauge is accurate 70% of the time. There's nothing that's accurate 100% of the time. And as one wealth manager said to me, he said, gee, I only need to be right 51% of the time. Well, you'll be right 70% of the time by depending on the power gauge rating. So that's pretty good. But it is important to have that independent model to guide you, as opposed to, guess what, your emotion. All right, little background on the power gauge rating. This is a recap of the performance going back to 7 years ago. And what this is saying is that where the average stock was up 9%, which is pretty close to that 10%, S&P average over 20 years. But for this span of 7 years, the average stock was up 9%. If you were holding only very bullish stocks, your account would have been up 20%. Likewise, if you were only holding very bearish stocks, your account would be down less than 1%. So this should give you some confidence that the power gauge is correct in identifying a stock's potential and moving you in the right direction. So NASDAQ, you've all heard of NASDAQ, took notice of our power gauge rating. They came to us back in 2013 and said, hey, we've tested this. It's very solid. We want you to create some indexes for us. So we took their large cap, small cap, and dividend achiever index and overlaid the power gauge rating on those baskets of stocks, filtered out stocks that had a neutral or a bearish rating, and then that went into the index for the year, and it was unchanged for the full year. So since these were launched in April of 2014, they've outperformed their benchmarks big time, as you can see by that middle column in red. I mean, look at the small cap fund. It's up over 40% of its benchmark. I mean, that's like phenomenal. And the other ones aren't too shabby either. So this really does give confidence that the power gauge does give you an edge, and we all need an edge in our investing and trading. So then New York Life took note of this, and they've now introduced an ETF so that based on the power gauge rating, so that money managers and their clients can now invest in a portfolio of stocks based on the Chaikin power gauge rating. So this is the first time an ETF has come to market based on the power gauge rating. And New York Life registered these 3 NASDAQ indices, the small cap, mid cap, and large cap, and they launched the first one this past May. Now, we are not registered. I'm not making a recommendation to buy this. I'm clearly saying this is validation, that if organizations with reputations such as NASDAQ and New York Life are now putting their weight behind and their confidence in the power gauge rating, you should feel pretty confident that that's a reliable tool for you to use as well. One more proof point: we're used by the pros, quoted in the media. Mark's quoted in the media frequently on CNBC, and he's appeared on most of these news shows here, not all of these news shows here, I should say, to name a few, and we've been written about in Barron's 3 or 4 times, Forbes, Market Watch, etc. Okay, so I'm going to move on to step 2. I just want to pause here for a second and make sure everyone's clear on the power gauge rating, because that's a real it's a centerpiece. It's a cornerstone of what we're going to be talking about, because everything else hinges off the power gauge rating. So let's go on to our second biggest mistake: lacking confidence. I'll tell my own story on lacking confidence, because my lack of confidence in investing in the stock market cost me a great deal of pain and money. So one of the reasons, really the primary reason I'm here today preaching to you, is so to help you avoid doing what I did. But because I didn't have confidence that I could manage my own investments, I turned it over to somebody else, and that caused a lot of pain. And that's really why I'm here today, in the hopes that you'll embrace this methodology and take control of your own financial future as well, so that you don't have to go through what I had to go through. But going back to when I first started investing, it was with 401k plans with companies that I worked for. I worked in New York City for Elizabeth Arden and L'Oreal, and then outside Philadelphia with the Franklin Mint. And at the time, they gave me a choice of maybe 3 or 4 mutual funds to invest in, and those funds were great. Fidelity's Magellan Fund, managed by Peter Lynch, is still considered the best managed mutual fund ever. I think it was up an average of 28% a year for the 15 years he managed it, and I happened to be in it during that time, so that was cool. And then I was in Bill Miller's Value Trust, which was a Legg Mason mutual fund, which was great. So as these funds were growing, though, and as my career was building, and I felt like I really, again, I didn't have the confidence to take control of this, be in control of this, I asked around to a number of my friends if they had a wealth manager they could recommend, and was referred to a young man who took all of the mutual funds that I was in, sold them, and then put me in 8 or 10 mutual funds of his choice. So that was okay up until about 2008. And we all know what happened then. You know, it was obviously the financial meltdown. And I kept calling him, and he kept saying, no, you just need to hold on. There's no point in selling. They'll all come back. Even though I knew they were going down. I was calling him like starting in September of 2008, and it was clear everything was falling apart. But again, because I lacked the confidence, I didn't want to overrule his decision, because basically, you know, I felt, well, gee, he's a professional. He should, you know, he should know more what to do than I do. What do I know? However, I changed my tune in spring of 2009, after the account had already lost 40%. I just said, this isn't working for me. I've got to take the money out, close that account out. And that's when I opened the Vanguard self-managed account and put it into an S&P 500 until I could figure out what to do. But it was a pretty devastating time for me. And I mean, I'd worked years, 20, 30 years to build that fund up, by squirreling away as much as I could into those, as much as was allowed in those 401k plans, and had given up doing other things that would have been more fun, like taking vacations and stuff, because I was socking this money away, believing that that was the right thing to do. So when it lost 40%, it was well, it's devastating. I don't know how else to say it. It was. And it was kind of a double hit on me, because I'd grown up, I've been very fortunate to grow up a very comfortable lifestyle, but that all changed the year I was going back to my senior year in college, when one of the investments my father had made turned against him in a big way. And his attorney recommended he file for bankruptcy. My father was a very honorable man. He said, no, I'm not going to do this. So I'm not going to file for bankruptcy. I'm going to meet my obligations. But what that meant is like divesting himself of our life, boat, summer home, main house, etc. So going through this again, some 30 years later, it was like, I can't believe I'm really going through this thing again. So at first I was obviously incredibly upset. Then I got angry, but then I got resolved to take control. And that's what I want you all to do, is to take that same resolution to take control of your financial future. Because as I say, really nobody cares more about your money than you do. So it's worked out fine now. I've taken the account And through this investing with Chaikin Analytics, I've been able to build it back over 350% since when I took it over. So it's okay now, but I've got the battle scars going through that, and that's for sure. So again, I want you to have the confidence to trust yourself and trust this methodology that I'm going to be teaching you, to build the confidence in yourself that you can do this. Because if I can create this type of wealth with no prior experience in the stock market or finance or economics or anything like that, then certainly you can too. All right, so let's move on to one of the other mistakes. And I think this was the second or the third one that you all said was your biggest challenge, one of your biggest challenges, and that's trading on emotion. You know, what's hype versus what's real? I mean, think back to those kind of brain slides I did in the power gauge section where, you know, we can only focus on 3 or 4 things at a time, but 50% of what analysts say is wrong. So it's like, what do? Well, most of us are more likely to buy stocks of companies in the news, you know, that the analysts are talking about, or the CNBC, you know, fast money hosts are talking about, or invest in companies, you know, they like. I have so many friends of mine have invested in like Facebook and Google and Apple because they like the companies, but they're not looking at what's underneath the hood to see if it's really a company that is likely to grow and be profitable going forward. So what we do is depend on something we call a classic bull. And this is the pattern, the setup pattern that I go through every time I'm evaluating a stock. If I'm going to buy a stock, it has to have these 4 trends. Power gauge rating, certainly bullish. It needs to be trending up in price, not flat or certainly not down. And then Chaikin money flow and relative performance need to be strong. And I will, excuse me, I will explain those too on this chart of Cigna. So let's use Cigna as an example. So I bought this stock back in late November. You can see that little triangle. That's a buy signal that's triggered on the workstation, on the platform. And that triggered, this was on my watch list. It triggered, and so I bought this stock back here at about, I think it was 128 or so. And it's now up, you know, 185 or so. And it just triggered another buy signal up here. So let me do this little annotation drawing thing. So see if that works. Okay, so I bought it. Yeah, I bought it here. And now you can see this really nice trajectory going up. The price is trending up, right? That's what you want. Let's look down here at, let me clear that. Let's look down here at the bottom. This is the power gauge rating, this green ribbon across the bottom. You can see since November of last year, we've had a bullish power gauge rating. So that's great. I like to see a power gauge rating persist for at least a couple of months to make sure it's going and staying in the right direction before I buy it. This next heat map here is called relative strength. And this is how well is this stock doing relative to the S&P 500. And if it's green, it's outperforming. If it's red, as it was doing last October, it's underperforming. Well, if you're going to buy a stock, you want it to be outperforming the S&P. Otherwise, just put your money in the S&P and be satisfied with a 10% annual, average annual return. But I like to outperform and get higher returns. So these have to be green in here. This is money flow up here, this little mountainous line here. And what this does is that this measures institutional money coming in and out of a stock. And this is an indicator Mark created some 35 years ago on Wall Street that's still used today. I mean, there isn't a professional trader out there who doesn't use Chaikin money flow when he or she is evaluating a stock. And you'll see it in different ways. It could say CMF. It could be called the Chaikin oscillator, but it's really on every stock charting package worldwide. And it was really what gave Mark his name on Wall Street. So the green means institutions are buying. As you can see, they doing in a big way back here, February, March. April means the institutions are selling. And why is this important? Well, it's important because a lot of a stock's price is based on supply and demand. And if institutions are buying, as they were back here, it becomes more scarce. And when a commodity becomes more scarce, you know what happens? It becomes more expensive. So it pushes the price up. Likewise, if the institutions are all dumping a stock, look back here in last October, they were dumping this big time, the price tends to go down because there's a glut of that stock on the market. And the only way they can sell it at that point is if it is priced more attractively, in other words, less. So it's very different from the fragrances that I sold in the cosmetic business, because those fragrances maintained a certain price, whether you bought it in January, whether you bought it in June, it was still the same price. Obviously, that's not so with a stock, but understanding that this money flow can really help you identify those periods of buying and selling. And look what happens when everything else is equal here in April. The only thing different is there's money coming out. And this is typically is what happens when there's money coming out. It kind of flattens out its growth curve. And then when money started coming in again, look what happened. It picked up again. I mean, that's how powerful this is. Money started going out, it flattens out. Money's coming into it now. It's going up. It had a little pullback here, but it just triggered another buy signal and it's going back up again. So it's very predictive. And I pay very close attention to money flow. So let's look at another example. There we go. Okay. But first, let's look at this Wyckoff chart. Now, when I first looked at this, I thought this was kind of confusing, but it really isn't. This is a gentleman who taught classes on investing in the stock market, and he came up with this pattern of how a stock price moves. So when it's on the move, it's what you get from Uber when they're picking you up on the move. When it's on the move and trending up, it doesn't go straight up. Again, it just does this zigzag pattern and it spikes up, pulls back, spikes up again. It's important to be aware of this pattern as well, because you want to buy a stock when it's pulled back, as you can see by this what he calls throwback here, and you want to sell it when it's spiking up. That's when you want to sell it. You don't want to sell it when it's down here. So understanding this pattern will help you understand where a price is headed. So let's put that into practice here. This is another what we call classic bull, D.H. Horton. This is in the construction and building services industry. And just right before, like 5:04 on CNBC, they had an analyst on there speaking about these home building stocks. And he was recommending D.H. Horton and also Toll Brothers. Now we have a bullish power gauge rating on Toll Brothers as well, as you can see from D.H. Horton. He also recommending KB Homes and LEN. I don't know what, I think that was Lennar. Those we have neutral power gauge ratings for. So if I wanted to invest in the home building section, I'd be looking at D.H. Horton and Toll Brothers over KBH and LEN, even though KBH beat the analyst estimates and their stock is up in the aftermarkets. But profit potential, I really depend on what these indicators are telling me. So I first have to have a power gauge rating of bullish, as I still do here. So let's see, I bought this stock back on this arrow back in August, again on this buy signal. I use these buy signals to help guide me with timing, you know, and we'll cover this again in the timing, but just be mindful of these little green diamonds are buy signals, red diamonds, green diamonds are buy signals, red diamonds are sell signals. And so you can see one triggered here on a pullback. See that look at that Wyckoff pattern. Spiked up, went sideways, dropped down, spiked up again. I buy it on the spike down. And that correlates with this overbought, oversold signal here. This basically maps out the Wyckoff pattern, the zigzagging of a stock. So again, you want to buy it when it's down here. You want to sell it when it's up here. So right now it's dipping down. It would not be the ideal time to sell it. And there's a lot of money still coming into this stock. So I think this stock has more room to go, just looking at what I'm looking at right here. A lot of money flow. This had been on my watch list for a number of weeks. Mark also puts out a market commentary every Sunday, and he identifies a particular stock to write in more detail about, called his stock of the week. And this was his stock of the week back in early August. So I was paying particular close attention to it. And then I get this buy signal and the pullback, and I go, fine, you know, this is a money flow buy. It was telling me there's a lot of money coming into this stock. It was oversold, meaning it was dipping down. Everything else was green. Industry was strong, and you know, it's performed really well. So one more classic bull. Let's look at Elbit Systems. The examples that I use are stocks that I either own or have owned for the most part. Elbit Systems is one of them. This is an aerospace stock. Very strong industry group, 4 out of 64, and I'll explain industry groups later, but you want to buy strong stocks in strong industry groups. This passes both check marks. This again had been on my watch list. And let's look at this. Green power gauge, outperforming, money coming in, not as strong as I would like. I love it back here, February, March, and look what happened to the price back there when all that money kicked in. It really took off. And I dropped down the one-day intraday chart on this, which is really helpful, particularly if you're trading the stock that day. It can really help pinpoint the time you want to do it. So this hit a 52-week high yesterday, and it was up again, I think another 2% today. And it did trigger, I bought it on a money flow buy here, and you can see it correlated with this dip down, the oversold condition. Today it triggered a momentum buy. However, you see that it's overbought. It's up here above the 70 mark on this overbought, oversold. So now is not the ideal time to buy it. You know, you want to, again, wait for that pullback. And they always do pull back. They may not pull back as much as you like, but they never go straight up. Or I shouldn't say never, but in most cases they don't. This is a pretty good run here, but then you see it does pull back. So how do I know what stocks to buy in the first place? How do I find them? You can't buy them if you can't find them first, right? So I alluded to Market Insights, which Mark puts out every Sunday, and that's how I got the idea for D.H. Horton back in August. Well, earlier than August, back in April, he had 2 stocks of the week that he really drilled down on in big detail, both technology stocks, and Excelis and Entergis. Now, I bought both of them actually, and on Excelis, which you'll see here, I made a profit of 34% in 3 weeks, and on Entergis, I made a profit of 9% in 4 weeks. Well, that's good. So how did I do that? Well, I put it on my watch list once Mark had talked about it in his Market Insights. And then right after that, a few days, I got a buy signal. This little triangle here, money flow buy, telling me there's a lot of money coming in, and look at this money coming in. So you know how I'm partial to that. And look at this, it was dipping down. Just because you get a money flow buy doesn't mean it's the right time to buy, because it could be overbought. So it's just one component that you need to look at. But look at that in relationship with everything else on this chart. And really everything you need to know about a stock is right here on this chart. So I bought it April 18th here at 18. Had a really nice fast run up, spiked way up here. I should have sold it up here. But I sold it as it was pulling back. And you might remember they called it the tech wreck, June 15th, that the tech stocks all just were pulling back. So I thought, well, I'll just take my profit now. So I pulled back, I took the profit. It still was I sold it at 25, bought it at 18, made a 34% profit in 2 months. So that was really nice. Now the stock has since, you can see it's kind of gone sideways, but now it's coming back into its own again, and had a 6% move yesterday and another nice move today. So, you know, they do turn around, but you know, when you see a pattern like this, if I had owned it in here, I probably would have sold it, you know, as it was, you know, kind of breaking down in here, but you can see it's recovered. And now it's got strong money going into it. So this would be a stock I would put back on my watch list. I have put back on my watch list. And if there's a good opportunity to get back in, you know, I'll do that. So we get a lot of testimonials from our subscribers. And Norm B here says, through following your excellent system, my portfolio now stands in excess of $1 million. Before Chaikin, I would make money and then lose it. Consistent earnings, underlying consistent, were just not a reality for me. Chaikin has changed all that. I can't thank you enough for your tremendous service and excellent methodology. So if you want, we all want consistent earnings, right? You don't want inconsistent earnings or consistent losses. You want consistent earnings, you know, but it does beg for you to follow a system. So the other thing I look for when I'm buying a stock is I want a strong stock, I mean, that classic bull pattern, but I want it to be in a strong industry group. Well, what is that? Well, every stock, each of the 5,000 stocks are earmarked into one of 64 industry groups that Zacks has identified, and you can see them here on the left. And you have a much higher likelihood of success if you invest in strong stocks in strong industry groups. I highlight the aerospace here. So you can go into our system and say, hey, show me the 18 aerospace bullish rated stocks. Or, you know, show me the major banks. There's 18 rated bullish. So you can do that if you're partial to a certain industry group. But what I prefer to do is to use what we call the screener. And this is a really cool feature that I think is like the best thing we've done with this entire system, because it allows me to put in my criteria and screen for stocks that meet that criteria. So you can see here, you know, I've highlighted on the platform, the screener. You get this little drop down thing menu, and I can just plug in what I call Sandy's criteria bullish, which you can see right here. And it patterns after that classic bull pattern. Power gauge rating must be bullish. Oh, you know what? I didn't copy the above. The universe, you can put in like S&P 500, you can put Dow 30, you can put the Russell 3000. Sorry, it didn't copy it, but I put in that it has to be in a strong industry group, and it automatically filters out everything but the top 20% of industry groups. So I don't have to go industry group by industry group, looking through all of the stocks, the bullish stocks in the aerospace, for instance, and all the bullish stocks in the bullish, to see if they meet my criteria. I know just by asking this, telling this, show me only stocks that are in strong industry groups that I'm going to get the top 20%. And then I know from putting in money flow and relative strength being strong that I'm only going to get stocks that meet that criteria. And then if you recall, there were 3 factors of the 20 factors in the power gauge rating that I like to focus on: price to sales, short interest, and insider activity. I want those all to be strong or bullish. So I take a universe of 5,000 stocks to start with, and literally in seconds, I'm down to 7. Now I flip-flop mid and large cap against small and mid cap. And the small and mid caps are outperforming the market right now. So I've been tending to look for those. But I thought this gave a better overview just because it was a little bit tighter and fewer stocks in here. Textron I own, Bruker I own, APO I own, Xerox I don't, but it's got a buy signal on it. So you can put this into a list, and then let's go into each of those stock charts. Well, I'll only go into Xerox because of the time, but you can see it's triggered a momentum breakout buy. Now, looking at this chart, I don't have to drill down on the power gauge rating, which I can do on any stock, but I don't have to because I know those 3 factors I like are strong. I know the power gauge rating, relative strength, and money flow are all strong because that's all part of my criteria. What I don't know is if it's overbought, oversold, but I can look right down here and I can see, oh wow, it's a zigzagging way up. This is not the best time to buy. It's also bumping up against this, what we call an upper volatility band. And what these are really they kind of, I think of them as channel, as it's within, I'm a sailor, so I think of this as a channel. And it keeps you in the channel. This is the price that the stock will likely stay in between the top one and the bottom one. And when it goes above the top one, it's often a good time to say, if you own it, gee, this is a good time to take my profit because it's not likely to hang out up here. It's likely to pull back. And likewise, if it goes below this lower volatility band, this zigzag, it's a good time to say, hey, maybe it's time to get out of this stock. This orange line just smooths it out. It's like a 200-day moving average, and it just smooths it out. But would you buy this stock now? This isn't a poll question, but the answer to be that my answer would be no. I would wait for this stock to pull back because you can see it's been hanging out up here enough times in the next few days or so. It should start pulling back. But this is a good candidate to put on my watch list because it's met all my criteria. So those rules that I've done and factoring those rules into a screener really puts me in control. So this has taken the emotion out of my trading because it's objective. You can't fall in love with a stock. It's just objective data that you're looking at. And I now, instead of being fearful about and having anxiety attacks over looking at stocks and money, I now think of it as fun. I actually enjoy it. One of our subscribers early on, even before the screener, said there's not enough time to do the work Chaikin puts before me in minutes, and she's wowed. So that's pretty cool. It really does save an enormous amount of time, particularly the screener. Okay, so let's move on to the 4th mistake a lot of us fall into, and that's we get fearful. I mean, nobody likes to lose money. It's inevitable, though, that you will lose money. And this was kind of a hard lesson for me to learn because I was like, oh my God, stock's going down, I'm losing money. But it's part of the game, and you cannot expect to make money on every trade. And even Warren Buffett doesn't do that. So it's okay. And if your fear or intolerance of loss is so high that you can't sleep at night, then it's not the right game for you. You're better off just putting it into the S&P 500, and that's okay. But if you can accept the fact that there will be losses, the trick is how to minimize it, okay? And most of us hold on to a stock too long. So here's the pattern to look for to know when a stock is breaking down and you don't want to own it. If you do own it, you want to get rid of it. It's the exact opposite of the classic bull. We call it the classic bear. And let's look at this on a couple of charts, including the Wyckoff chart as well. So you want to do what Warren Buffett says and avoid risk whenever you can. This isn't the time to be bold and boisterous and take big gambles. You don't want to do that with your money. But there are signals and ways you can tell if a stock is breaking down. So let's look at Advanced Auto Parts. Now, this is a stock that Mark's been talking about, gosh, in his market insights going back to early April. And I circle early April there because that's where you see the red triangle. We've been looking at green triangles, but here comes the sell signals. This is saying there's a relative strength sell signal. You can see it correlates up here. That's telling me that this stock is underperforming the market, relative to the S&P. And if you look at this chart, we've been bearish on this stock since February. That February was like, what, 160 or so. And then certainly in April, you got this sell signal that would, if you own this stock, that would alert you to say, hey, you really should be out of this stock. And you can see money flow was negative and it was underperforming the S&P 500. We also include articles, and I've included a screenshot of the articles that includes it displays the first two, but you can click on this little arrow here and see other articles. But I used to have to go to like Yahoo Finance or NASDAQ to search articles to see if there was anything that would affect the price that I should know about. But now they're right here. And you can see, this was yesterday, it's the 209 most shorted S&P 500 stock. Well, you heard me say one of my factors that I look at for a stock I'm considering buying is short sellers. I don't want them shorting the stock that I'm considering buying, and they're telling you this is one of the most shorted stocks on the S&P 500. Well, that's not a good sign. So they're betting that the stock is still going to go down, and it's already down to 99 from 150 up here when the sell signal triggered. So this stock is now down 35% from when Mark first started talking about this and the automobile stocks. There were like 3 of them, and they all had the same pattern, and they all were dropping like stones. But this is what you want to avoid. You want to, when the power gauge turns neutral, that's when you start saying, this stock, it might be breaking down. And then look here at money flow. You can see the money flow back in December, mid-December turned. Well, that's a really telltale sign. That would be the time to get out of this stock. Now, back when it was up at around, 170 or so. There was a relative strength buy signal here, but remember these don't look at everything you're looking at. Relative strength looks at relative strength, and relative strength was outperforming. However, money flow was coming out, and the power gauge rating, which remember is 20 factors instead of 1 here and 1 here, is telling you it's going to neutral. So you've got to put it all together and say, I don't want to buy this stock right here. Rather, I would be selling it with this money coming out. And that was tipping you off that the stock was going into a decline. Again, it follows this Wyckoff pattern, with the zigzag routine, except, breaking down. It zigzags down more than it zigzags up. Nike's been in the news a lot. They just reported the other day. You can see we triggered a sell signal on this shortly before, about a week before it dropped, and look what happened. It was dropped. This is yesterday's. I took this slide yesterday, but they reported in the morning, and it was down 3.5% by like 12:30, and I think it dropped a little bit more. But you can see the pattern here. It's red. This is not a stock I would want to own, and this is when you've got to avoid. But if you do own it, and you see this pattern start to break down, let's go back here to April, where it's neutral. Relative strength started to turn against you, and certainly when the money turned against you. And those three things lined up in late April, early May, when the stock was like 55. That's really a good time for you to say, hey, I'm going to get out of here. Or what a lot of our options traders do is that they put options on here, and make money on the downside. And we've had a lot of subscriber feedback on the great calls they've made based on the power gauge rating and the charts you're looking at right here to make money on the downside. But it's important to look for that pattern. And let's look at one more. Amazon, another stock, one of the infamous FANG stocks. Was up huge, last year and the year before. It's up 27% so far this year. But again, look what happened. It kind of, the analysts say it rolled over. We like to say it goes through a personality change. Everything's kind of happy in here, good money flow, strong relative strength, but the power gauge is saying, not so fast. You might want to really, look at this closer. And going into earnings are these little EPS flags here. When this stocks or companies are required to report earnings every 3 months, every quarter. And if they beat, it's green. If they disappoint, it's red. And typically what happens when they disappoint is the stock price drops down. And obviously the reverse, if they beat. But there tends to be volatility around earnings. But you can see by the pattern here, come July, August of this year, when the power gauge turned bearish, that would have been a time I would have gotten out of this stock, because you can see relative strength was dwindling. It's now negative. Money flow is not very strong. It's now ticking back to red. You got this recent sell signal up here, alerting you that the relative strength was breaking down, which indeed it is. So this is not, this is not a stock I would want to own, but it is a popular stock, and they were talking about it. There was an analyst on just 2 days ago on CNBC talking about Amazon being his favorite FANG stock. Joe, you want to put up a poll question, and let's just see what you all feel. Now that your eye has become accustomed to looking at these charts, is this a stock you would buy right now, or would you avoid it or sell it if you owned it?
All right, let's see. So that poll question is up. Give you guys a few seconds, probably about 10 seconds.
Thanks.
And let's see. All right, let's take a look. And it looks like, yeah, overall majority, avoid or sell it.
Okay, that's great. Now, 88% avoid or sell it, so that's great. Those of you, the 13% who said you would buy it now, you really don't want to buy this stock now. Everything's telling you this stock is breaking down. You see this red power gauge rating, red relative strength, and the money flow is ticking into red zone. This is not a stock you want to own, even though they're telling you on CNBC and elsewhere, that Amazon does great things. So this is where you got to take the emotion out. Pretend it's not even Amazon, just kind of blank over the name. And that can help take the emotion out, because you've got to look at what the chart is telling you here. and your eye will get used to it as you're coming through this. So in short time, in seconds, you'll literally be able to know whether it's a stock you want to own or not, just by looking at that chart. All right, so Rex here, followed the Amazon trade. He did put options, and his profit covered next year's total cost of 2 months in Hawaii after taxes. So there is profit potential on the downside, and a lot of our customers have made really nice gains from it. Okay, let's quickly move on to timing. This is your number one concern. When do you get in and out of a stock? Well, I've got some rules we're going to go over, but there are also the signals, the buy signals and the sell signals that I've been pointing out along the way. There's also that overbought, oversold signal. So I'm not going to spend a lot of time on signals because I've been pointing them out, but just know that there's 6 pairs you can overlay, and they will trigger when certain criteria is met. So how do you know when that criteria is met without, going through all these charts, which nobody has time to do? Well, we've put them into what we call an alerts view. And you can see here, I've taken my watch list. You can take any list. I keep a list of stocks I own, and I keep a list of stocks I watch. And every morning I put this alerts view, which is this little bell here, I overlay that, or click on it rather, and it gives me this menu of signals, if any buy or sell signals have triggered, and then other alerts. So like if a power gauge is changed from neutral to bullish, it'll tell me, or vice versa. It'll tell me if an analyst estimate has changed, and that's likely to drive the price of a stock. So really any of the important things about a stock that's likely to change the price or affect the price is pushed to me like this. And I go through this on the stocks that I own and then the stocks that I'm watching every morning and every night. And that's my 10 or 15 minutes. It doesn't have to be more complicated than that. Now on my watch list, since I'm only want to buy stocks that are bullish or very bullish, I'll only scroll through the charts of stocks that are bullish or very bullish. Things that have dropped to neutral, I'll just skip. I don't need to look at those. I'm not going to buy them. They might change, and I'll look at them when they change. But right now, I'm not going to waste my time. So that's how you can save your time and just zero in on what's important. So let's look at this alert from 2 weeks ago. This was this was a webinar I gave 2 weeks ago. I overlaid the alerts on my watch list, and you could see here that this Beazer Homes triggered a relative strength buy signal at 15. So let's look at it today. This big yellow arrow is that relative strength buy signal on 9/13. And look what happened. Stock has gone up 20%, gone up from 15 to 18 in just the 2 weeks. But look at the chart. I mean, the chart looks pretty good, right? It's all green, a little bit of money flow here, but that's normal for money to kind of flow in and out to some degree. But look at this now big chunk of money flow coming in to this stock again, and it spikes way up. So this stuff is powerful, and following the discipline can really point you in the right direction and give you the edge. So what are the alerts doing on my watch list today? I overlaid them again, and here G3, among other things, has triggered a money flow buy. So let's look at that stock, because this one might be something you want to put on your watch list. Here's that money flow buy signal that it just triggered. I overlaid oversold buy to see when they had triggered, and there's been quite a few of them recently, 3 since June, that all would have gotten me in at a really good time. Is this a stock you would want to buy right now? Well, I would say yes. It's oversold, it's dipping down. Strong power gauge rating since June, relative strength strong since mid-July. Money could be a little stronger, but it looks like it's picking up. And it's telling you that it's picking up because you've got this money flow buy signal. And it's in a strong industry group. And I did go on to my 3 factors and they're okay. So, this is a stock I'm seriously considering buying. But that's really how easy it is. Now I see we're at time now, and we're just getting into timing when to buy and sell. So I'm happy to continue. If you want me to, those of you who can't stay on, this will, as Joe said earlier, this webinar is being recorded and it will be sent to you tomorrow morning. But Joe, you want to take a quick poll and see if the folks want me to continue or just skip and get it on the video?
Yeah, let's see. Let's take a look at where we are right now. We do
Okay.
know timing was a big was a big topic. So let us know. I'll give it just a couple more seconds, and we'll see how the results dictate.
This will take about 10 minutes to go through these this section.
All right, let's see. And looks like we should proceed.
We shall proceed. Okay, great. Those of you who said skip it, you will get the recording tomorrow because I know everyone's time is carefully allocated. But thank you. This is great. I'm happy to continue. Okay, so here's my rules. Well, there's 2. Well, let me go back one way. Okay, there's 2 instances of when to buy or sell, or when to sell primarily. Is one to take the profit, get out while the getting's good, or you sense that the stock is breaking down and you better get out before it changes and goes against you. So these are 2 separate rule sets. So let's review when you take a profit. What are my rules? Well, price hits that upper volatility band. That's that zigzag, that kind of hyphenated channel line I pointed out, the white hyphenated line. The price is overbought. That means it's zigging up instead of zigging down. The price spikes after strong earnings report. And I did allude, I'll point that out more clearly. I did allude to the volatility that can happen around earnings when a company disappoints or exceeds analyst expectations. So this is a chart going back to March. And this is on Lamb Research. This stock has been a huge winner. It's up 70% so far this year. Been a really strong stock. I had it on my watch list. I bought it in March. You can see there the yellow arrow with a buy signal. Actually, it was late February. It was a money flow buy signal. And you can see that it was oversold here. Very strong power gauge rating since June of last year. And this was because this is a chart from March. And going back, also very strong money flow and relative strength going back to March as well. So a really solid growth curve here. So I had this on my watch list. It triggered this buy. I got it on my alerts view, bought the stock at, where did I buy it? 117. And then it went up above this volatility band, this white zigzag, my channel marker line. And I thought, well, this is good. It's gone up 10% in 3 weeks. I'm just going to take my profit and be happy. And you can see that, it hit a 52-week high shortly thereafter. So I sold it up here, took my 10% and was happy. But then I bought it back because, here's the February where I bought it the first time and I sold it up here. And then I put it back on my watch list. I waited for a pullback, and the pullback came right before they reported earnings. And you can see it was also oversold. It was dipping down. Everything still was green, just a teeny bit of red that really isn't meaningful. So I said, well, gee, how has this company done earnings? From what I can see here, the last 4 quarters, it's exceeded analyst expectations and thus done well. How is it done over time? Well, we have this 5-year view here. So I went to the 5-year view. This is what I saw. I was at this yellow arrow. This is, where the time cut off when I did this chart back in, I think it was June. So I could see, oh, good heavens, for the last 4 years, since 2013, this company has beat analyst expectations. And look at this fabulous growth curve. So I felt pretty strongly that this is a stock I could depend on pretty reliably to exceed analyst expectations once again and spike up. And that's indeed what it did. So I bought it where you can see there at 120, I think it was 126. It was less than where I'd sold it a few weeks before. And then I sold it 3 days later, when it spiked up another 10%, was hit that, above that upper volatility band again. So, and then I'm thinking, oh my God, I should have stayed in this. Well, I did in fact buy this stock back and make more money on it again, because this stock just keeps going up. But that's how you can make money during earnings and take that 10% spike, on the profit, which is what I did back, April 21st. Here's that 5-year view that gave me confidence that they were going to continue beating the earnings, which they did. And here's one of our subscribers who also makes money on those types of earnings play. He said in the first 2 days of using Chaikin, he more than paid for his annual subscription. Second week, he made over $15,000 on 3 earnings plays. I like the combination of several indicators on one page. Clear, easy to follow signals, saves time, and improve the returns. He considers it a gold mine of profitable ideas. So here's another example of when to sell taking the profit. And this, even though it goes back to February, March, is still the best example I have of, why it's a good idea to sell and be satisfied at that upper volatility band, even though, like in the case of Lam Research, it does continue to go up. But sometimes it's better just to take those steady gains and be happy than risk more. So I bought this stock back here in December. It had been on my screener, so thus on my watch list. I bought it December 6th at 16 down here when it was oversold, dipping down. Everything else looked great. All green and go. Looked great. Insurance, strong industry group all year. It's number 7 out of 64 now. It was strong then. It still is. And then I sold it up here when it hit this upper volatility band. You can see it just bumped up against that. And I thought, wow, that I would take a 17% profit on 2 months, and it's just starting to go negative on the money flow. And at the time, power gauge was still green, relative strength was still green, but this had just started to waver into the red zone on money flow. I thought I better just get my profit and get out of here. So I sold it at almost 19, took a 17% profit. And literally 2 days later, they pre-announced their earnings. I've never heard of a company doing that, but they pre-announced it and it dropped 10%. And then you can see when they announced earnings again, it continued to drop and drop. And it's done nothing but go south. So you can see what happened. Once power gauge turned neutral, which was only a few days after I sold it, and then a week or so later, relative strength and money flow really kicked into the negative side, and it just has this trajectory on the way down. But it's 60% lower than when I sold it back in February. And how would you like to ride that down and know that you missed out on an 18% profit and instead are taking a big loss? You don't want to do that. So that's why it's so important to have these rules, these objective rules. It takes the emotion out. So the other scenario of when to sell is there's a stock that's breaking down. So power gauge turning neutral and another indicator like money flow turns negative. Certainly if you get a sell signal, and if the price drops before that orange line, that 200-day moving average line, or below that lower volatility band. Now, I only have one example here because I frankly am usually out of stocks before they get to the point of breaking down. But I could sense this stock was breaking down, and so I'm still using this as my example. I bought this back in June, had been on my watch list. Entergy utilities have been really strong all year. I got a buy signal, relative strength buy. Everything was green, but then like the next 2 weeks, it just started dropping. Money flow turned negative, relative strength turned negative, and the power gauge turned neutral. So and it dropped. You can see it was dropping below this lower volatility band and below the orange line. So I just took a small loss, got out of the stock. I sold it at 76. I bought it at 78, sold it at 76, took a small loss. And now it looks like it's kind of came back a little bit. But one last poll question for you all. Do you think now, looking at this chart, would you get back into this stock and buy it now? Does it look like an attractive opportunity to get in? This is our last poll. And you guys have been great participating. Thank you so much.
And let's take a look.
Great. A very strong 93% saying no. And that is what I would do as well. Power gauge is neutral. Relative strength is negative. Money flow is negative. The only thing in this favor is it is oversold. It's dipping down. So that tells you it's a good time to buy it, but you don't want to buy it because these other indicators are negative or neutral. Okay, great. So by now, you've learned how to avoid these 5 mistakes and overcome these challenges of not having the right tools. You now have the power gauge rating to guide you, the antidote to information overload and the antidote to picking poor stocks. You now have gained the confidence because you can rely on these tools that are proven and reliable. You don't have to trade on emotion anymore. You know now what's hype versus what's real by looking at the chart, the indicators, certainly the power gauge rating, money flow, relative strength. That all gives you that classic bull setup. And you don't need to be fearful of losing and holding the stock too long because you now can recognize, 88% of you recognize that classic bear pattern. So that's great. You'll know when to get out of stock or avoid it altogether. Like tonight, they were talking about the home building stocks, and they were recommending some stocks that we were neutral on. That's the end of conversation. LEN and KBH, neutral. I wouldn't even go there. So you have the power now of the knowledge, and with that power, you can do great things. And you don't have to rely on anyone else right now. You can rely on the data that you see and the analysis that we give you. And certainly the biggest issue, the timing issue, when you get in and out, you now have seen the rules that I follow and you see how effective they've been at keeping me out of big losses and allowing me to take profits, at the right time. So here's another recent recent testimonial from a subscriber. He's gone from 235,000 to 1.2 million in 7 months. He said he's been trading stocks for many years without much success, but on January he found us, started the year with 235,000, and on July 30th he was up to 1.2 million. So that's pretty, it is doable. John Malden, another partner of ours, says his analysts are enthusiastic users of Chaikin. He does recommend it in his work and in his symposiums and conferences. And Mark has been on the road with First Trust, going around the country with them, as has another one of our employees, and they are meeting with the New York Life investment IQ's salespeople who set up accounts, appointments with wealth managers, many of whom have already bought Chaikin because of John Malden's recommendation. But he says it is integrated into their routine due diligence process for vetting and evaluating potential investments. Um, Another very recent from September 11th testimony from a subscriber. He's planning on renewing because at this point the program has made it possible so that I'm knocking on the door of a salary for a neurosurgeon, and he knows what that is because he has a friend who's a neurosurgeon. So he's a happy subscriber ready to renew for another year. So we want you to be our next success story so that you can enjoy some of the perks that come with making money in the stock market. And you can do that through what we call the Financial Freedom Fast Track, which is, are powered by our Chaikin Analytics platform. This has won the award from Benzinga for Best Stock Ideas Platform through the screener, and there's actually a discovery engine we didn't even have time to get into. But we are really pleased to get this award. Out of 18 companies that were up for the award, we got voted the best stock idea platform, which is pretty cool. So you get a number of free bonuses in addition to the platform. You get that screener that I shared with you. Um, for those of you who trade options, there's an overlay which gives you the best risk reward scenarios. I didn't get into that, but our customer success team gives webinars, forums every week to our subscribers to show them how to use and trade options with Options Play. Certainly, we did get through the 20-factor model, the power gauge model in length, in depth, but not the stock discovery engine. This is like a Pandora for stocks. You can seed it with a stock, and then it'll tell you stocks like that, which again is part of the reason we got that best stock ideas. So the platform sells for $2,195 a year, but we're taking $300 off as a thank you for attending tonight's presentation. And if you'll stay with me, we're going to make that a little bit better and throw in more free bonuses. The 1-day chart. I think I did show you on a few of the charts how you can just click on that and you'll get the real-time price data during the day, the earnings. I alluded to that, but you can drop down and see exactly what they reported. And on the right is a screenshot from an iPad of Mark's weekly market insights where he gives great ideas. That's where I got the Excellus idea, for instance, in D.H. Horton. Plus, there's even more to come. And I think these are really great. This is direct access to a customer success consultant anytime you want. We offer small group tutorials, and when you subscribe by tonight, you'll be into a tutorial as early as tomorrow to help you set up and use all the features. And this is unlimited. You can come to as many of these coaching and support sessions as you need to or want to. And there's always new stuff we're talking about, new features on the platform to show you how to use them. And if you need more dedicated support, you can schedule a one-on-one coaching session. And again, this is for free. So I think this is a huge huge benefit because, I mean, really our success depends on your success. We want you to be successful. We want you to be sending us those types of testimonials that I read to you. So I told you we're going to make it a little bit better. We're taking another $100 off when you subscribe by midnight tonight. So get that $400 savings. You can call 877-697-6783. We have our customer support team waiting. Or you can email them at sales@chaikinanalytics.com or go onto the website and go right to that order form that will have the offer discount already taken out. But I do have an extra bonus for you, an extra free bonus, And that is my 5-step guide. It's a PDF guide to how I find winning stocks. It takes you through the 5 steps I go through, that classic bull pattern, the classic bear, the screener, what I put into my screener, what are my rules for when I sell. It's all in this one PDF. So if you want to get that sent to you for free, contact our customer support team, 877-697-6783 or sales@chaikinanalytics.com. They'll get that out to you instantly. So I thank you all for a great session tonight. I'm so happy that your answers all came up the way I wanted them to. And I really thank you for your attention and concentration to stay with me through the presentation. So Joe, I'm going to turn this back to you to close it up.
Great. Thank you so much, Sandy. And everyone, again, thank you very much for joining us this afternoon. The offer is $17.95 for a full year to Chaikin Analytics. You can contact us at 877-697-6783 or go right to chaikinanalytics.com/Sandy. Tomorrow, we have one more support webinar to take place. That will be our onboard session. This is perfect for each and every one of you. We're going to give you an idea for how you can create your own list in Chaikin Analytics. We'll show you how to identify all of the different indications in our program. I saw there was a question, how can I access Chaikin Money Flow in Chaikin Analytics? We'll show you exactly how all of that works. So it's a great way to hit the ground running, but the best step for you to take at this point is to take advantage of Sandy's offer, $17.95 for a full year to Chaikin. So make sure to join us here again. Reach us at 877-697-6783 or send us an email, sales@chaikinanalytics.com, or of course, chaikinanalytics.com/Sandy. So keep an eye out for the recording to be sent out tomorrow. Until then, have a great evening, and we will see you on tomorrow's onboard session.